The latest U.S. inflation report suggests price pressures may be easing after proving stubbornly high so far this year. So, does that change the market's view on when the U.S. Federal Reserve may begin cutting interest rates? Joining us now to discuss, Alex Gorewicz, VP and Director for Active Fixed Income Portfolio Management and TD Asset Management. Alex, always great to have you on the program.
Thanks, Greg. Great to be here.
All right, so this seems to be one of those reports where at least we're not moving in the wrong direction. What's your read on it?
I think you summarized it perfectly. Maybe just a quick recap, whether we're looking at headline month over month or core month over month, 0.3%. Year-on-year numbers, 3.4 and 3.6% respectively for headline and core. These numbers were basically in line with expectations. In fact, like month over month headline was a slight miss. So obviously the market liked that. All markets like that. Bond markets, equity markets. And probably the reason why is a psychological development. This is the first time that you're probably sitting opposite someone in many months talking about U.S. inflation meeting or missing expectations.
Yeah, using that word easing.
Right. And I think that's extremely important. Now, the devil's in the details to some extent, because when we look at, let's say, super core inflation, which is core services excluding any shelter-related components, if we look at the last 3 months, including the latest print, if we look at the last 6 months, if we average those numbers and then annualize them, we're still looking at figures that are over 6%. That doesn't actually give the Fed a lot of confidence. However, similar to some of the other numbers that I mentioned, the good part about it is not that it comes in line with expectations. The good part is that the rate of change is slowing. We saw stickiness along all these sort of inflation measures in the last several months, and now we're starting to see that momentum wane, which is probably the positive outcome of today's print.
As you said, bond markets, equity markets liking this news. At the same time, I imagine it's the first of what the Fed is going to need to see through several reports across the different metrics to tell them that indeed they're on the right track.
Correct, and that's why I said, if you have to look at the details and you have to realize that the numbers are still not compatible with the Fed, returning to that 2% target in the medium term, 2% inflation target in the medium term. So, we have to take this with a grain of salt. It's maybe a step in the right direction, but by no means giving the Fed the green light to, let's say, lower its policy rate at its next meeting.
Now, somewhat overshadowing, being overshadowed by the CPI headline print is the fact that we had U.S. retail sales today. I didn't go too deep into it other than to see that they were flat. And so this seems to be another indication that perhaps the U.S. consumer is starting to say, wow, life's expensive. The cost of money is expensive.
Right.
Maybe I need to slow down.
That's an excellent point, because I think when we look at today's fall in interest rates across the yield curve, it seems to have been more of a reaction to those soft retail sales. Again, psychologically, the fact that inflation was not a beat, that it didn't come in firmer than expected, actually helped to pave the way for that. But today's retail sales, similar to some of the mixed data we saw yesterday in PPI, similar to, let's say, a couple of weeks ago when we had non-farm for March, you're starting to see now a string of data in the U.S. That is missing expectations. And as we know, and when we think about market reactions, it really is about what's been priced in, what's expected by investors versus what's delivered. And the last several weeks have delivered weaker than expected data in the U.S. From a total macro point of view. And I think that more than anything else is what is going to enable the bond market to say, well, maybe now we've priced out too many Fed rate cuts for this year, and maybe it's time we start pricing some back in.
All right, so this could create a situation where you have the market's expectations pushing back against what the Fed is telling us. Yep. It's been a push and pull for a while, right? At some points, it feels like the market's saying, no, we think you're going to do this much, and Jerome Powell's like, take it easy, be patient. He's been talking about patience for a while now, and the markets seem to fall in line with that. So you think there's maybe a disconnect as they say, be patient, let the interest rates do their work, and the market would say, no, we think you're going to go sooner rather than later.
Well, now that narrative seems to be, we think you're going to go as in cut sooner rather than later. But just a couple of weeks ago, there was a growing chorus of investors suggesting that the Fed needs to hike again. And in hindsight, I think Powell and the Fed did the right thing by saying, let's stay the course. Let's cut off that tail risk, we'll say, for more rate hikes, and just prolong our current policy stance. We'll delay when we start rate cuts, but the next move is more likely a cut. And again, the string of data we've seen in the last couple of weeks in a number of different indicators suggesting that the Fed is right to sort of, again, try to transition more towards easing.
When we finally do get the easing, when we finally do get the rate cuts, how robust will they be? How aggressive will they be on the other side? Or is this a case of we're going to stay higher for longer, and then when we finally do start cutting, we're going to take it slow?
The key here, and it's hard to say at this time, the key will be labor market data. What the Fed did by saying, effectively, we just need to hold the current stance longer, and then all of the data that came after that effectively suggested rates didn't need to move higher. What that all did is to say, well, actually, the Fed's position and the Fed's current policy stance could be restrictive enough, but the key will be labor data. And on days whether it was claims last week, initial claims that surprised to the upside, whether it was the non-farm data from a couple of weeks ago, it suggested that perhaps, yes, the Fed's policy stance is restrictive enough. So you've actually seen the response in markets be skewed towards sort of an asymmetric outcome, which is, well, maybe rates don't move higher. You have them move meaningfully lower, and then all other asset classes really like that.
Let's talk about the wait. And we've been waiting longer as investors than we perhaps thought we would be for the Federal Reserve to deliver a rate cut. What is the sentiment like among fixed income investors as they wait this out?
They don't like waiting. The hard part here is that everything that I've just mentioned is actually whipsawed the market around quite a bit. You're really super data dependent, which in some ways is boring, but in other ways is also very volatile from economic data release to economic data release. And I think for a long time, bond investors were conditioned to just expect capital returns, whether it was positive or negative, because yields generally were so low for the last 10, 15 years, up until a couple of years ago. And because of that, they didn't have the experience of having to wait for their income return or their yield return to compound over time. And so there's still in that, I feel like bond investors are still very much caught in that psyche where it's like, okay, I want my returns now. Like, okay, the Fed needs to cut interest rates, or the Bank of Canada will cut interest rates, and let's go positive returns. That hasn't happened, right? We are data dependent, and that data has been volatile. But when you take a step back, what you realize is your yields are actually helping to offset a lot of that volatility, but it takes time to compound those yields. It takes time to realize those yields. And I think that waiting and being patient part is something that needs to return to bond investors.